Peter Orszag, CEO of Financial Advisory at Lazard. How much stock do you put into this inflation number as far as a positive catalyst going forward?
Well, you know, Sarah, as I said before with you, we've been waiting for a moment like this. I think it would be good to see, let's say, 2 more months of the kind of disinflationary numbers actually showing up. But this was definitely a good moment for those of us who have been waiting for it to show up, which is to say that the inflationary pressure easing somewhat. And again, coming back to the point that we still have a lot of the impact of monetary policy tightening yet to come, yet to hit the economy, which is, again, one reason why central banks should just take this into account. It would be good to have, let's say, 2 more months before reaching any definitive conclusions, but it was definitely an encouraging sign.
And you have been worried about the Fed and particularly the ECB overdoing it when it comes to tightening policy. Does a number like this today make you feel a little bit better about where we're headed on that front?
Well, it depends what the Fed does from here, of course. But yes, I mean, the point behind that concern before was most of the impact of when the Fed tightens we haven't seen yet. So that's coming in 2023. And the point is, if inflation's coming down anyway, then you're going to get walloped with the lagged effect of the monetary policy tightening when you don't really need it. And you might be causing an unnecessary recession in an era when fiscal policy is going to be hamstrung by the likely divide between the Congress and the White House.
So that's where I was going to go next. Peter, what are you telling when your clients call you and say, what do you make of the midterms? What does it mean for the markets and the economy? What are your big takeaways that you tell them?
Well, first, I'd say the rejection of extremism was really encouraging for, just the governance of the country. But I also think those Democrats who are rejoicing need to just take a pause for a moment and realize that next year is going to be really challenging. And at the top of my concern list is what you mentioned with Brian Deese involving the debt limit. I think what should happen at this point is the most consequential lame duck session of Congress since at least 1974, if not before, in which you tackle the debt limit, you tackle funding for Ukraine, and you tackle other things, but those are the 2 top priorities that, if you don't do it now, could prove to be really difficult to do in 2023 and could, again, just create unnecessary uncertainty. And I'd highlight the imperative on the debt limit in particular, because it's not only that our politics are somewhat more radical than the past times when we've managed to land the plane, albeit a little bit in a bumpy way, but also the liquidity in the Treasury market is materially lower. You just do not want to be playing with matches around that potential fire. That would be a bad idea, and it would be better to do it later this year.
So what does all this mean for the business that you guys see? How much pent-up demand is there for M&A and IPOs and all the things that have gone quiet in capital markets as a result of the bear market? And are we going to start to see it open up if we continue to get these better inflation reads?
Well, I think there's a lot of pent-up demand waiting for the signal from the Fed in particular that the coast is clear in terms of interest rate increases in lots of different areas. We just launched a new infrastructure center here at Lazard today. We're very pleased that Secretary Raimondo was able to join us for part of that. And in that area, you see a huge amount of pent-up demand that reflects all of the infrastructure investment that we haven't made over the past decade or two in semiconductors, across the board, in broadband and so on. That's one of many examples of the pent-up demand phenomenon that you mentioned.
And then finally, Peter, I'm curious what you think about potential contagion, ripple effects from this Bitcoin latest blow-up disaster.
Well, we don't know yet because we still don't know whether this is fundamentally, the classic divide between a solvency problem and a liquidity problem. We don't know the second and third round effects. But I think what we do know is that this is going to lead to a much more aggressive regulatory stance on the area. In my opinion, the regulators have been waiting too long to get more attentive to this particular arena. And I think what we're seeing over the past several days is going to significantly change that.
Peter Orszag, thank you. It's great to have you on a day like today.
Thanks, Sarah.
We appreciate
Good to see
it.
you.